Welcome back to another episode of Ask the Hammer with Jeffrey Levine from Buckingham Strategic Wealth. Hi, I'm Bob Powell, and we've got more questions for the Hammer. Jeffrey, you ready for this one?
Yes, hit me.
All right, so a woman writes, I'm interested in investing in a fixed index annuity. Can you describe the features and benefits and the pros and cons of this product?
Sure, you have about 7 hours, Bob?
I do.
Yeah. So let's start with this, is that there are a variety of different styles of fixed indexed annuities out there. And so you have to look at your exact product in order to understand what the exact benefits are, what the exact drawbacks are. But in general, what a fixed indexed annuity is the first part. Let's talk about the fixed part. The fixed part means that your principal value does not fluctuate up or down, right? You're credited interest on a regular basis, but your actual principal value is locked in. So one of the benefits of this type of investment is that you don't have the principal risks that would be typically associated with other market style investments. In other words, what you put in, if you hang on long enough, you'll at least get that out, and in all likelihood, some amount higher than that. Now, the index portion refers to tying or fixing your crediting rate to a specific style of index. And that can be all over the place. Some give you many options. For instance, you might be tied to the S&P. You might be tied to international markets. It might be gold or real estate. But there's some underlying investment that your interest is tied to. And again, not principal, right? That's one of the big differences here. It's not your principal, it's your interest. So instead of, let's say, going and having a CD that you might buy at a bank where they say, we're going to give you 2% every year for this period of time, what a fixed indexed annuity says is, we're going to have your principal value. And then this interest rate that you get, potentially, is going to be based on how well this other thing does. Now, in terms of let's be realistic here, right? If you have zero risk on your principal value, then you're obviously not going to get all the upside, because otherwise everybody would do that. And in short order, the insurance company would be out of business, right? So they limit your upside in one of a number of potential ways. For instance, some have what's called a participation rate. Now, the participation rate says, for every X dollar that's earned in the overall index that you're tied to, you get a percentage. So if the S&P goes up 10 points in the year, 10%, and you have a participation rate of 25%, you would get 2.5% interest credited to your account, 25% of the S&P's 10% benefit that year. Another way that some companies look to mitigate their own risk, and again, give you some upside, but limit you so that they also can make money, is by giving you a hard cap. So others might say, well, you'll get everything the index does, but only up to a specified percentage. So for argument's sake, we'll give you the upside of the S&P, but you're capped at 3.5%. So if the S&P does -10, what happens for the year? Nothing. If the S&P does -5, nothing, again, because it's negative. If the S&P did 2, you'd be credited 2. If the S&P did 5, well, you'd be capped at that 3.5% amount. So if you started with 100,000, you'd add 3.5% of interest, that cap that they tied you to. And again, each product is a little bit different. Some have the opportunity to select from multiple different crediting methods, some that might limit you by participation, some that might limit you by cap. And in many cases, you can mix and match these within a specific investment. So it's about knowing your specific product. Now, having said that, what are the benefits? What are the drawbacks? Are these things good or bad? I'll start with the second one there. They're not good or bad. They are, right? They are. In other words, for some people, they're worthwhile as having as a part of a portfolio, particularly as a bond replacement vehicle. For others, it's not a good fit. My beef, if you will, with fixed indexed annuities is rarely in the products themselves, or at least today, less often with the products themselves, and more often with the way that they're positioned or sold by those dealing them. In particular, you often hear, well, you have no market risk, but you get the market upside. That is not true. Anybody could figure out that that's not true. It doesn't pass the golden rule, which is if it doesn't sound right, it probably, right? If it sounds too good to be true, it probably is. And that would absolutely apply there. So first is never assume you're going to get market style returns. It might happen based on your particular annuity and based on what the market does, but it is highly, highly unlikely. Rather, you should think of this as a fixed income replacement in your portfolio. And then the big risks of this are largely that your money is tied up. So if you need access, typically you're limited to that ability to access your principal during the time that you've committed the money to, whether it be a 5-year period, a 7-year period. And I said I don't generally have a beef with the products themselves, but I will say this. There are some pretty egregious surrender schedules out there for some of these fixed index annuities where it's, 15 years until you can see your money, your principal out without a penalty, or 20 years, whatever it may be. I think, you think about what happens over a 5 or even a 10-year period in someone's life. A lot can change. So I would be very cautious about how long you tie up your money for, unless you are absolutely 100% sure you won't need it. Because while you may have access to some amount each year, maybe 10%, what if there's an emergency? What if you need more of that sooner? You may have some real issues there if you haven't properly planned. Of course, again, the biggest benefit here is the principal protection. Ultimately, though, every one of these products is different. When you're looking at a fixed indexed annuity, just as you would any stock, any bond, anything that you would purchase, a piece of real estate, you've got to evaluate the specific benefits, the specific drawbacks of that particular investment.
Well, Jeffrey, I have to say that you nailed that one again. Much appreciated, and I'm sure our reader much appreciates the answer to this question.
Well, thanks for the opportunity, Bob. And, quick shout out there to the rest of our listeners. If you've got questions, make sure you send them to us. We'd love to hear from you. Bob and I live for these opportunities to talk retirement and taxes, etc. So hit us up at askthehammer@buckinghamgroup.com. Again, that's askthehammer@buckinghamgroup.com. We look forward to answering your question in another episode.